So good day everyone, my name is Jonamae Banilad and my topic for discussion is the controlling the financial reporting system. So Sarbanes-Oxley legislation requires that management design and implement controls over the financial reporting process. This includes the transaction processing systems that feed data into the FRS. So in the previous chapters, we studied control techniques necessary for the various transaction systems. Here, we will examine only the controls that relate to the FRS. So, there are potential risks to the FRS. This includes, first, an effective audit trail. So, an audit trail is a chronological record of all financial transactions within the system. It helps to ensure transparency, traceability, and accountability of financial data. An effective audit trail occurs when this record-keeping process is compromised. So if there are gaps, missing information, or irregularities in the audit trail, it becomes difficult to verify the accuracy and validity of financial transactions. This can lead to difficulties during audits, regulatory compliance checks, and internal reviews. And without a reliable audit trail, it's challenging to identify the source of errors or fraudulent activities within the FRS. Second is unauthorized access to the general ledger. So the general ledger contains sensitive and critical financial information. If an authorized individual gain access to this ledger, they can manipulate or alter data leading to incorrect financial reporting. So this can have serious consequences including mispresentation of financial performance, compliance violation, and loss of trust from stakeholders. And the third potential risk is the general ledger accounts that are out of balance with subsidiary accounts. So, the GL serve as a central repository of financial data, while subsidiary accounts represent detailed accounts for specific transactions or groups of transactions. So, out of balance conditions occur when the total balances of the subsidiary accounts do not reconcile with the corresponding general ledger account balance. This can happen due to the entry errors, system glitches, or issues with data integration between different modules of the FRS. Such discrepancies can lead to inaccurate financial reporting, incorrect calculations, and difficulties in tracking down the source of discrepancies. Last is incorrect general ledger account balances because of unauthorized or incorrect journal vouchers. So journal vouchers are used to record financial transactions in the general ledger, updating account balances accordingly. So incorrect or unauthorized journal vouchers can lead to misstatements in general ledger account balances. Unauthorized vouchers might be created by individuals without proper authorizations, potentially to cover fraudulent activities. And incorrect vouchers, on the other hand, can result from errors in the data entry, coding, or calculations. These inaccuracies can distort financial reporting and decision-making, making it crucial to establish strict controls over the creation and approval of journal vouchers. So based dun sa nabanggit ko na 4 potential risks to the FRS, so if they are not controlled, this risk may result in misstated financial statements and other reports, thus misleading users of this information. The potential consequences are litigation, significant financial loss for the firm, and sanctions specified by SOX legislation. SAS 78 or COSO control issues. So they are transaction authorizations, segregation of duties, access controls, accounting records, and last, independent verification. So let's have in-depth discussions on this on the next slides. First is the transaction authorization. So the journal voucher is a document that authorizes an entry to the general ledger. And the journal vouchers have numerous sources such as the cash receipt processing, sales order processing, and the financial reporting group. So it is vital to the integrity of the accounting records that the journal vouchers are properly authorized by a responsible manager at a source department. Next is the segregation of duties. So it is a fundamental principle of internal controls in accounting and finance. So we've seen how the general ledger provides accounting verification control. To do this, the work of maintaining the general ledger must be distinct from all accounting and asset custody responsibilities within the organizations. Therefore, individuals with access authority to general ledger accounts should not first have record-keeping responsibility for special journals or subsidiary ledgers. So these separations helps prevent errors and fraudulent activities where an individual might manipulate both the subsidiary records and the general ledger, effectively covering their tracks. Second is prepared journal vouchers. And so, allowing individuals with access authority to prepare journal vouchers can create a conflict of interest and undermine internal controls. If the same person who can manipulate general ledger account balance is also responsible for creating journal vouchers, they could potentially use this authority to manipulate financial data for personal gain or to cover up errors. So separating the preparation of journal vouchers from general ledger access helps ensure that any changes made to account balances are subject to independent review and approval. Last, have custody of physical assets. So individuals with access authority to general ledger accounts should not have direct custody of physical assets because it creates an opportunity for mishandling, misappropriation, or theft. If the same person responsible for adjusting general ledger accounts also has physical control over assets, they could potentially manipulate financial records to hide asset misappropriation or other fraudulent activities. So by segregating these responsibilities, the risk of asset-related fraud is reduced and proper oversight and accountability are maintained. And the third cause of control issues is access controls. So unauthorized access to the general ledger accounts can result in errors, fraud, and misrepresentations in financial statements. So kung sinong individual lang ang may rights to access doon sa accounting records, journal, ledger, source documents, sila lang dapat yung may karapatan. So, no unauthorized individuals are allowed. So that's why SOX legislation implement controls that limit database access to authorized individuals only. So only authorized personnel can access and manipulate critical financial data. Next is the accounting records. So the audit trail is a record of the path that a transaction takes through the input processing and output phases of transaction processing. So we have encountered this in the potential risk to the FRS. So this involves a network of documents, journals, and ledgers designed to ensure that a transaction can be accurately traced through the systems from initiation to final disposition. So furthermore, an audit trail facilitates error prevention and correction when the data files are conveniently and logically organized. So, the general ledger and other files that constitute the audit trail should be detailed and rich enough to, first, provide the ability to answer inquiries, for example, from the customers or vendors. Second, be able to reconstruct files if they are completely or partially destroyed. Third, provide historical data required by auditors. Fourth, fulfill government regulations. And last, provide a means for preventing, detecting, and correcting errors. So, the COSO framework underscores the importance of maintaining proper documentation, timely recording, and accurate representation of transactions in the organization financial records. And the last COSO control issues is the independent verification. So, independent verification involves an objective assessment of internal control processes and their effectiveness. So, the general ledger function as an independent verification step within accounting information system. And the FRS produces two operational reports, the journal voucher listing and the general ledger change report, that provide proof of the accuracy of this process. And the journal voucher listing provide relevant details about each journal voucher posted to the general ledger. And the last topic that I will discuss is about the internal control implications of XBRL. So, it is a standardized markup language used for presenting and exchanging business and financial information. It enables organizations to tag their financial data, making it easily consumable by both humans and machines. So, under the internal control implications of XBRL, matatackle natin dito yung taxonomy creation, taxonomy mapping error, and validation of instant documents. First is the taxonomy creation. So, a taxonomy serves as a dictionary or a set of standardized definitions for financial concepts. So, when taxonomy is incorrectly generated, it results in an incorrect mapping between data and taxonomy elements that could result in material misrepresentations of financial data. And controls must be designed and put in a place to ensure the correct generation of XBRL taxonomies. Second is the taxonomy mapping error. So, the taxonomy mapping errors occur when the financial data is incorrectly associated with XBRL tags during the process of tagging financial information using the established taxonomy. That's why the process of mapping the internal database accounts to the taxonomy tags needs to be controlled to ensure the accuracy, consistency, and reliability of financial reporting. So, by implementing controlled mapping procedures, organizations can mitigate the risk of errors, enhance transparency, and maintain stakeholder trust in their financial data. Also, correctly generated XBRL tags may be incorrectly assigned to internal database accounts, resulting in material misrepresentation of financial data. So, proper mapping ensures that financial data is consistently and correctly categorized, preventing material misrepresentations of financial data in the XBRL reports. And the last internal control implications of XBRL that I will discuss is the validation of instant documents. So, validation of instant documents refers to the process of ensuring that XBRL tag financial data conforms to the defined taxonomy and adheres to reporting rules and standards. So, once the process of mapping financial data to XBRL tags within the established taxonomy is completed, the next step is to generate XBRL instant documents. So, these instant documents are essentially the finalized financial reports containing the tagged data. And the independent verification procedures are established to ensure accuracy, integrity, and adherence to standards of the XBRL instant documents before they are posted to a web server or shared with stakeholders. That's end my report. Thank you for listening, and I hope you gain something.